absorption or digestive issues.
Meters is fine.
Strong opinions on the matter.
3. It sounds better?
You get free services. Colonial.
Guys,
I'd like to come.
Talk. Leader talk.
100. We need
You to be able to buy.
we have to tax businesses, all businesses, what business currently pay in taxes. We have to tax all individuals what.
Both smooth surfaces and rough surfaces. And the best part, it doesn't drip. Paint ceilings with no ladders and no splatters.
Spin on the ball.
To order by credit.
Marco is part of a medical.
Hello, hello, hello. Test. Hello, hello, hello. Test 1, 2, 3, 4. Hello, hello, hello. Audio test, hello, hello, 1, 2, 3, 4, audio test, 1, 2, 3, 4. Audio test, 1, 2, 3, 4, audio test, 1, 2, 3, 4, audio test, 1, 2, 3, 4.
That Christmas morning, Detective Steve Guillermo was looking forward to a relaxing holiday when he got a call from a colleague.
He calls and he says, "Hey, we gotta go out and work today." I was like, "Yeah, right, you know, it's Christmas morning."
But after hearing the details, the badly mangled bike, a young woman who died of severe injuries, Guillermo knew there was no waiting.
We knew we had 2 crime scenes that we're gonna look at.
Week.
Perfectly legitimate. Get out there.
Up to $500.
Civil nuclear power reactor.
States.
No.
Man, use the...
And fires in the...
Peaceful and...
That you feel a little uncomfortable. If you're going to be seeing this.
Then what we have over here is...
Mr. Chairman, you ready? The Subcommittee on Commerce, Trade, and Consumer Protection will now come to order. The purpose of today's hearing is to hear witnesses on the subject, the proposed Consumer Financial Protection Agency, implications for the consumers and the FTC. And I certainly want to welcome all the witnesses, Mr. Barr and Chairman Leibowitz. The chair recognizes himself for 5 minutes for the purposes of an opening statement. I would like to thank all my colleagues and all the witnesses who diligently worked to prepare testimony over the 4th of July holiday so that today's hearing would be as meaningful as possible as we commence our examination of the administration's proposal to create a new Consumer Financial Protection Agency. My view on the matter is fairly straightforward. I believe that the FTC should remain intact as it is currently constituted, and that this committee and subcommittee should continue to oversee and authorize the FTC. The commission, which was established in 1914 during our nation's progressive era, was designed to be a regulatory agency with disinterested expertise to ensure competition and to promote free enterprise. That mission and those prescient concerns are as vital today as they were almost a century ago. The Commission operates best as a lone eagle. From high above, the agency can survey the marketplace and swoop down on predators that deceive unsuspecting and misinformed consumers. The higher and farther away that the FTC is from other agencies and the entities that it regulates, the better it is at spotting unfair commercial and trading practices and at isolating those practices that cast the longest shadows. Similarly, by staying at a distance, the agencies can keep would-be captors at bay while staying on course to achieve its critical mission of protecting consumers. Looking at all reliable indicators, the Commission has performed commendably for small and scrappy staff and abridged powers. Working along with a 5-person bipartisan commission are approximately 1,100 dedicated employees spread out across 3 bureaus: Bureau of Competition, Consumer Protection, and Economics. Although its expertise is deep and broad, the FTC's statutory tools under the FTC Act consist of an antiquated and cumbersome form of rulemaking under the Magnuson-Moss Act paired with anemic litigation authority. These tools may be successful at landing glancing blows, but they fail to pack the full punch of deterrence that businesses will respect and consumers deserve. Currently at the FTC's disposal are its expertise and its agency-crafted instruments of research and policy and study development, consumer complaint and education, competition, legal analysis, and economics. What the FTC does well, it has done without peer relative to its sister agencies. And what it hasn't done particularly well is well in the process of being fixed. Just a few weeks ago, our subcommittee worked intently to mark up H.R. 2309, the Credit and Debt Protection Act, which directs the FTC to adopt rules using APA rulemaking authority that will address rampant, unfair, and deceptive acts and practices in the area of payday lending, automobile finance, mortgage and foreclosure rescue, and debt settlement. Our subcommittee's objective in passing H.R. 2309 was to confer more authority upon the FTC and equip it with sufficient resources so that it could adopt rules faster in the areas of credit and debt through APA rulemaking procedures and bring enforcement actions carrying the threat of civil penalties. Our committee has worked devotedly in the past more than a few times with members from the Financial Services Committee to bolster the FTC's shortcomings, hold out the FTC's best practices for banking agencies to emulate in protecting consumers and to improve the ability of bank regulatory agencies to protect consumers by issuing unfair and deceptive rules under the FTC Act. I have witnessed the respective chairs of the committees on Energy and Commerce and Financial Services jointly introduce H.R. 3525 to tackle some of these challenges. Further, I offered a friendly amendment to H.R. 3526, which was introduced by the chair of the Financial Services Committee in the 110th Congress, to require that the GAO report investigating federal banking and credit union regulations and the perpetuation of unfair and deceptive acts and practices by depository institutions. Importantly, this push and pull between our respective committees has pressured the providers of financial services and products, including banks and depository institutions, to balance the allure of profits and determination of safety and soundness against the needs of consumers. This collaborative working relationship between committees has produced good and sensible consumer protection bills to safeguard consumers of financial services and consumer credit products. It is a viable example of the independent agencies that will be affected by the administration's proposal, as it will allow each of them to maintain their independence and respective biases, experience, and expertise when addressing serious problems that cut across industry sectors and affect market suppliers and consumers. I want to thank the witnesses for being here today, for taking out time from their busy schedule to be and to participate in this hearing. With that, I yield back the balance of my time. The chair now recognizes the gentleman from California, the ranking member, Mr. Rodalowicz, for 5 minutes for the purposes of the vote.
Thank you, Mr. Chairman, and good morning. I appreciate your calling today's hearing on this important topic. Whenever something goes wrong in this country, Washington proposes a solution, regardless of whether the situation calls for one. However well-intentioned our actions, they rarely work out because they are often undertaken as a knee-jerk response. We have seen many unintended consequences of rushed legislation in recent history. For example, the Sarbanes-Oxley Act. At best, we have seen marginal improvement in the markets while diverting billions of dollars toward new compliance costs to the detriment of many small and medium-sized businesses. In another example, last Congress, we enacted a law in response to lead paint on toys. The paint violated an existing standard, but what was a compliance problem rather than a deficient standard problem led to numerous costly new mandates that put many small and medium-sized businesses out of business because the cost was too high without any corresponding increase in safety. This is not to say that weaknesses in our financial system don't exist. They obviously and clearly do. The failure of so many financial institutions and the ongoing problem of foreclosures on mortgages some borrowers never should have taken out are evidence of that. And if the bailout of banks and financial firms really were necessary to save the financial system, something clearly needs to be done to address the systematic risk. Additionally, fraud and deception by both lenders and borrowers in the mortgage market ran rampant. The FBI reported an increase in fraud by more than 400% since 2005. Few people questioned anything was wrong in the market until home prices started plummeting and borrowers began defaulting. If uniformity in the enforcement of existing laws can address these problems, I would support that. Apart from the lack of systemic risk regulator to prevent future financial collapses required in the taxpayer bailout, I am still trying to understand what holes exist in the FTC's Consumer Protection Authority and to what extent the government contributed to the crisis with its intervention in housing policy. I am far from convinced that the market problems require the creation of a new federal regulator as contemplated by the administration's proposal. Fannie Mae and Freddie Mac are under government control in part because they did exactly what Congress and the government wanted: extend home ownership to as many people as possible under the watch of the federal regulators. Fannie and Freddie, along with the federal housing agencies and programs, were encouraged to extend credit, and when they did, they and their shareholders paid the price for failing. To accomplish the policy goal of extending home ownership to as many people as possible, changes in lending standards had to occur. The lowering of lending standards meant more borrowers qualified for loans they couldn't afford. My point is that laws on the books didn't stop people from taking out riskier mortgages, either in spite of or because of rapidly increasing home prices. Nor has it stopped regulators and law enforcement from prosecuting those who we now know committed fraud and broke the law. While many experts believe that the banking regulators performed their duties inadequately, I will leave that to the Financial Services Committee to decide. But with regard to the FTC, it seems to me that we are throwing out the baby with the bathwater by stripping the authority over consumer protection for financial products and services from the one agency that has performed well. If we agree we need legislation, we should take the approach of legislating with a scalpel rather than with a bulldozer. With that said, I have two primary concerns with this proposal. First, it creates a new federal entity with an enormous scope of authority. The proposal grants sweeping authority to a new agency over financial products that would cover every sector of the economy. As I understand it, the draft legislation would touch everyone from a certified public accountant to a realtor and subject them to a new tax to fund the agency. Second, I'm concerned about transferring functions from the FTC to a new agency without any evidence that it is necessary or that it will be as effective as a regulator as the FTC is. By removing the FTC's authority, we could lose the FTC's unique expertise in balancing consumer protection and competition. Finally, the legislation contains several new broad authorities for the FTC regarding rulemaking authority and civil penalty authority. I have previously disagreed with these and do not need to repeat them at this time. However, I do have some questions of the witnesses regarding these provisions, and I will ask them when they are appropriate. I want to welcome the members to the panel as well, and yield back, Mr. Chairman.
The Chair thanks the gentleman. The Chairman of the full committee is recognized for purposes of opening statements for 5 minutes.
Thank you very much. I want to thank you, Mr. Chairman, for holding this important hearing. Last year, as chairman of the House Oversight Committee, I held several hearings examining the causes of the financial crisis. Those hearings revealed a government regulatory structure that was unwilling and unable to meet the complexities of the modern economy. We found regulatory agencies that had fully abdicated their authority over banks and had done little or nothing to curb abusive practices like predatory lending. The prevailing attitude was that the market always knew best. Federal regulators became enablers rather than enforcers. The Obama administration has developed an ambitious plan to address these failures and to strengthen accountability and oversight in the financial sector. Today's hearing will take a close look at one piece of that plan, the proposal to create a single agency responsible for protecting consumers of financial products. A new approach is clearly warranted. The banking agencies have shown themselves to be unwilling to put the interests of consumers ahead of the profit interests of the banks they regulate. And the structure and division of responsibilities among these agencies has led to a regulatory race to the bottom. The Federal Trade Commission has taken steps to protect consumers, but its jurisdiction is limited, and it has been hampered by a slow and burdensome rulemaking process. I'm pleased that this subcommittee is holding today's hearing and examining the administration's proposal carefully. There are two areas in which attention and focus from this committee are particularly needed. First, the new agency must be structured to avoid the failures of the past. It only makes sense to create a new agency if that new agency will become a strong, authoritative voice for consumers. And second, we must ensure that the Federal Trade Commission is strengthened, not weakened, by any changes. Unlike the banking agencies, FTC has consumer protection as its core mission. In recent months, FTC has taken great strides to protect consumers of financial products, bringing enforcement actions against fraudulent debt settlement companies and writing new rules governing mortgages. The administration's proposal would give most of the FTC's authority over financial practices and some of FTC's authority over privacy to the new agency. At the same time, the administration proposes improving FTC's rulemaking authority and enforcement capabilities. It's not clear what impact these proposals would have on FTC or its ability to perform its consumer protection mission. As we build a new structure for protecting consumers of financial products, it's our responsibility to ensure that we do not weaken the agency currently responsible for consumer protections and this and many other areas. Once again, I thank Chairman Rush for holding this hearing. I welcome our witnesses to the committee. Look forward to their testimony.
The Chair thanks the Chairman of the full committee. And now the Chair recognizes the gentleman from Florida, Mr. Stearns, for 2 minutes for the purposes of opening statement.
Good morning, and thank you, Mr. Chairman. This is a very important hearing. It's important for us as members of this subcommittee, and Mr. Chairman, in terms of our jurisdiction and what the implications are for jurisdiction in the future. The administration's newly proposed CFPA, or the Consumer Financial Protection Agency, is relevant. It's an idea that a lot of us have mixed reactions on, has implications for our subcommittee. Although this is only one component of the administration's broad-reaching financial regulatory reform proposal, it certainly is an important part of that overall program, and it needs detailed examination. We must carefully consider the long-term effects that this will have on the Federal Trade Commission, the consumers it is charged with protecting, and on industry. Currently, the Federal Trade Commission has broad authority to protect consumers from unfair and deceptive practices in the credit and debit debt areas, and the FTC has notably been an effective and reliable agency in terms of consumer protection. We've seen it on this subcommittee. However, this new agency, the CFPA proposal, strips the Federal Trade Commission of virtually all of its consumer protection authorities pertaining to financial practices, and even some of its privacy protection authority. So, Mr. Chairman, I think that's got to be concerned. The proposal compensates for this shifting of authority by granting the Federal Trade Commission streamlined Administrative Procedures Act, APA, rulemaking authority and the ability to seek civil penalties against unfair and deceptive practices. But this is a term which there's no clear definition, as well as making it unlawful to, quote, aid and abet, quote, in deceptive acts. So due to the shifting of power and the potential economic consequences of businesses, we must ensure that effective stakeholders have a voice at the table, but ultimately we need to be assured that the CFPA, the new agency, will be an agency designed to do what is in the best interest of the consumers and not what is in the best interest of the bureaucrats who run it. One other concern I would have, Mr. Chairman, with the APA is it has 180 days for consideration. Is this sufficient time? Under the Mag-Moss Act, rulemaking requirements included a public hearing. And so, Mr. Chairman, perhaps as this bill moves along, we might want to include some kind of public hearing incorporated as well as this 180 days of consideration. And with that, I yield back to my balance of my time.
The Chair thanks the gentleman. The Chair now recognizes the gentleman from Michigan, the Chairman Emeritus of the full committee, my friend Mr. John Dingell, for 5 minutes for opening statements.
Mr. Chairman, I thank you, and I commend you for this hearing. It is a very important one. It follows on a series of events which began with a raid on this committee by other committees and by the banking industry and by repeal of Glass-Steagall, which removed all the penalties and prohibitions against many of the illegal activities which brought us to the current lowest state in which we find ourselves financially and economically. At the Treasury Department, there was an office still in being called the Comptroller of the Currency, who pushed to totally deregulate the banks and to unlearn the lessons which we learned during the Depression, and to permit the abuses which the Pecora Commission found to be a problem. Things which brought about the 1929 crash. And lo and behold, the failure to learn those lessons or to preserve the protections which the Congress and the President in the 1930s put into place led to the economic collapse which occurred in the United States in the last calendar year and this calendar year. So the questions that we are watching are very close. The questions that we will be concerned with is going to be, are consumers protected? Is the Federal Trade Commission able to continue doing the work that it does to protect consumers? And this committee is going to concern ourselves this morning with these issues and means by which to ensure improved consumer protections continue to exist with regard to financial products and services, and to see to it that the Federal Trade Commission is able to carry out the responsibilities which in a rather contemptible fashion were disregarded by the SEC and also by the Comptroller of the Currency. Now, we need to know if our concerns here and the pause which it gives us occurs in part because of a transfer of existing authority from the Federal Trade Commission to a newly minted Consumer Financial Protection Agency, an agency whose behavior we don't know, but an agency which is going to probably be composed of many of the good-hearted people who have brought us to this curious and unfortunate state of events. I will be truthful, I have significant concerns about these plans, and I will be intending to engage today's witnesses in a frank discussion about their merits. The administration, which has no fault in the events of the deregulation and the collapse of the American economy in last year, envisions consolidating all consumer protection functions related to financial products, including rulemaking, supervision, examination, and enforcement under the aegis of the new CFPA, which would receive sole rulemaking enforcement authority over consumer financial protection statutes such as the Truth in Lending Act. At first glance, this strikes me as a de jure and possibly unwarranted reassignment of FTC's consumer protection authorities in the financial services area. I will be looking to see whether this is so and whether, in fact, it is a good thing or can be justified by the administration. While a comparatively small agency, it is to be observed that FTC has done superb work in protecting consumers. And in this, the country would benefit not from a diminished mandate to that agency, but rather to additional statutory authority, personnel, and funding. Consequently, I have more than a modest degree of skepticism regarding the administration's proposal. In brief, I wish for our witnesses to elucidate upon several matters associated with the CFPA proposal. First, if CFPA were mandated under law, what authorities would be left to FCC, or rather to FTC, and why would that occur? Second, what latitude would FTC have in enforcing consumer protection statutes as they relate to financial services? And what consumer protection statutes would be denigrated or dissipated under this proposal? Third, how would one characterize the level of interagency cooperation in the drafting of the administration's proposal? Finally, if CPA receives its proposed mandate, what will become of this committee's jurisdiction over consumer protection as designated under Rule 10 of the House of Representatives? I will welcome the witnesses' responses to these and other questions in order to properly establish an adequate record for additional action by the Congress if such is deemed necessary. I would ask at this time that I have unanimous consent to keep the record open, to submit a list of questions to the witnesses today, and to have those responses and the questions inserted into the record. I want to commend you, Mr. Chairman, for your courtesy and foresight in this hearing. I would conclude by a personal note in welcoming Dr. Stephen Calkins, Associate Vice President for Academic Personnel and Professor of Law at Wayne State University in my home state of Michigan. His testimony has been invaluable to my understanding of this matter, and I look forward to his participation in the continuing debate on consumer financial protection. And I note, Mr. Chairman, that my wife is a member of the Board of Governors of that great institution, which gives me a particularly warm feeling about it. And again, Mr. Chairman, I urge you and my colleagues to be most diligent, most cautious, most careful, and most dutifully suspicious of the events that we inquire into today. Thank you.
Mr. Chair, thanks the Chairman Emeritus. The Chair want to put before the committee the UC request, and hearing no objections, so ordered the UC request by the Chairman Emeritus. And the Chair also wants to take a moment of personal privilege to to celebrate the Chairman Emeritus' birthday and to wish him a happy birthday. So we want you to know that we all wish you a very happy birthday and many, many more.
E3, a fellow's a little more careful about celebrating his birthdays. The good news is I'm celebrating my 83rd birthday. The bad news is that I'm 83. I thank you, Mr. Chairman, for your courtesy, and I thank my friends for their kindness and their courtesy.
Thank you. The Chair now recognizes the gentleman from Kentucky, Mr. Whitfield, for 2 minutes for opening statements. Right, excuse me, I didn't see Mr. Barton there. He just walked in. Okay. He usually walks with a much bigger step. Mr. Barton is recognized the...
well, you can go to Mr. Whitfield. He was here before me. I'm fine with going to Ed, and then come back to me after the next group.
Y'all work that out then. Okay. Mr. Whitfield.
We're all very polite today, so thank you very much. Mr. Chairman, I want to thank you also for holding yet another important hearing examining the ongoing financial crisis and ways we can help our constituents get through these difficult times and mitigate future problems. Secretary Geithner said that this new Consumer Financial Protection Agency would have only one mission, and that is to protect consumers. It's also my understanding that this proposal would eliminate the consumer protections at the FDIC, the Federal Reserve Board, the Comptroller of the Currency, and the impact on the FTC Perhaps we should explore expanding the authority of the FTC. Another problem that concerns me about the proposed legislation is that there is no federal preemption of any state law that is more stringent than the federal law. And anyone that's gone through a mortgage process, and when they hand you the 45 pages of documents, you're going to find yourself getting more documents if you have these conflicting state laws on these consumer issues. And I think that's a real concern as well. But the problem that I have most of all is how much will this cost? Every day we pick up another article in a newspaper, growing national debt, maybe next economic crisis. Unless we demonstrate a strong commitment to fiscal sustainability in the longer term, we will have neither financial stability nor healthy economic growth. Interest payments on the debt alone last year was $452 billion. This year it's expected to be $470 billion, the largest federal spending category after Medicare, Medicaid, Social Security, and defense. Another article today, economist declares train wreck because of out-of-control federal budget deficits. The Economist talks about the real question is how much damage will greater indebtedness do to economic growth and government's creditworthiness. Those things may transcend what limited additional protection consumers get from this legislation. So I think we need to move cautiously, find out how much cost are we talking about here and what will the benefits be. And thank you, Mr. Chairman.
The chair, thanks to the gentleman. The chair now recognizes the vice chair of the subcommittee, my friend from Illinois, Congressman Schakowsky, for 2 minutes.
Thank you very much, Mr. Chairman. I just came from a roundtable on women's financial literacy, clearly an important issue. But what we have found is how daunting the environment has been for anyone who even is pretty literate in financial issues. We've seen the systematic production and marketing and sales of countless of financial products, including mortgages that were extremely risky, even downright dangerous for borrowers, and often it was pretty hard to figure out what was what. For years, bank and non-bank lenders operated with too little oversight by government regulators, and when regulation was taking place, there was little focus on whether the financial products and services sold were safe for consumers. The Federal Trade Commission, and I'm so glad its chairman is here today, is essentially the only agency with a mandate to prioritize consumer safety and protect Americans from unfair or deceptive practices. And I commend Chairman Leibowitz for his renewed commitment to consumers' rights in the areas of credit and debt. However, as has been mentioned, the FTC's jurisdiction is limited to non-bank activities. The agency has been hampered for decades by cumbersome rulemaking authority, and in recent years its actions were limited by the previous administration's general contempt for oversight of the private sector. Overall, current regulations aren't sufficient, and they aren't working. We can't maintain a system which neglects consumer protection for the bulk of the financial service industry. Americans deserve access to honest information that will help them make educated decisions on mortgages, credit cards, and bank accounts. Dangerous financial products should be kept off the markets, and advertisers must be held accountable for their claims. We have to move forward with these goals, and I look forward to hearing today's testimony on how a consumer financial protection agency might achieve them. Thank you, and I yield back.
The chair thanks the gentleman. The chair now recognizes the ranking member for the full committee, the humble and honorable Mr. Barton from Texas.
Well, thank you, Mr.
For 5
Chairman.
minutes.
Thank you. Before I give my opening statement, let me amplify what you said about our Chairman Emeritus, Mr. Dingell. Some people get 1 year of experience, and that's it. In his case, you could say that would be 1 year 83 times. But in Mr. Dingell's case, each year he adds it to the base where it compounds and amplifies by orders of magnitude. I think you can honestly say that our friend and Chairman Emeritus is the most influential member of Congress in our lifetime, and it is such a privilege to have him on our committee. And it is really fun when he is on my side. It is not so much fun when he is not on my side, but even then I learn from him. So heartiest congratulations from the minority side to a true gentleman of the House, the conveyor and the protector of institutional viability for this body. We wish you many, many more. With regards to this hearing, Mr. Chairman, I would bring the members' attention to today's Wall Street editorial op-ed piece about the particular agency. It's entitled, "Let's Treat Borrowers Like Adults." It calls into question whether there needs to be a super consumer financial products protection agency, which the legislation we're looking at today would empower. We accept the intentions being honorable, but people like myself have extremely strong reservations about the implementation of such an agency. What would the legislation actually accomplish that some federal agency isn't already attempting to do? We'd like to know what's gone so wrong with our existing protection agencies that we deem it necessary to create another brand new agency. I'm a bit taken back by the breadth of the proposed coverage. This legislation, of course, relates a great deal to banking and other financial institutions over which this committee, unfortunately, has no jurisdiction, at least not now. One never knows about the future. But it reaches beyond that. It could reach accountants, auditors, gift cards, all other types of institutions and entrepreneurial activities. It doesn't fall strictly within our jurisdiction because it applies to banks, but it's still of concern. There seems to me to be an exception that swallows the preemption rule. According to the proposal, if I understand it correctly, state consumer laws of general application and those state laws enacted pursuant to federal law intended to, and I quote, exceed or supplement federal law will now apply to any national bank. The Harvard professor who's credited with inspiring this all-inclusive Consumer Financial Protection Agency described the need for it in her article, Unsafe at Any Rate. Professor Warren wrote that we need this agency in order to reverse industry practices that make it difficult for consumers to understand what they are getting in a financial product world. For example, 30 pages of contract terms for a simple credit card or 50 lines of convoluted and excessive text to explain all required disclosures. I understand that. I just co-signed for my stepdaughter's new condo in Austin, Texas, and it took an hour of signing various documents, some of which were documents I signed certifying that I just signed the previous document. So I understand the need for simplicity and the need for perhaps a review of some of the existing documents that we're asked to sign, but I'm not sure that this agency gets there. This bill would assume that businesses and their customers are eager to pay more for such protection, maybe even a lot more, because there are no limits on the burdens to either. There are all kinds of reports this new agency could mandate, regular and special requests, but there are no limits to how often the agency could require those reports. And there's no mandate to consider the burden placed on the businesses to produce these reports. The preemption provisions really convey no preemption at all. In one paragraph, the proposal mandates all state laws are preempted, but only to the extent that they conflict. In the next, the legislation permits a state law to supersede federal law if the new agency determines the state law is more protective. That seems to be almost in direct opposition to the prior paragraph. What if a company is compliant with the federal law, but while the agency hasn't yet determined whether a state law is more protective, the Attorney General believes it is and brings action against the business for a violation? Is that company liable for its violations of state law without any notice? This would seem to exacerbate the decisions, but rather by making certain that the products themselves don't become the source of the trouble. I see my time is about to expire, Mr. Chairman. I have another page and a half of written commentary. Simply putting me down is extremely doubtful about the positive impact of this legislation. I think we'd be better served on this committee and your subcommittee to go in and reform existing authority, clarify the differences between existing regulatory agencies, and if there's something that has really fallen through the crack, try to figure out one of the existing agencies like the FTC and see if we couldn't give them explicit authority in that area that needs reinforcing. With that, Mr. Chairman, I yield back.
The gentleman from Texas, Mr. Green, for 2 minutes for opening statements.
Mr. Chairman, thank you for holding this timely hearing to examine the administration's proposal to create a new agency that would consolidate and be responsible for consumer protection with regard to financial products and services. After the events of last year, there should be no doubt that Congress needs to act to further protect consumers with regard to financial regulation. This subcommittee has already taken steps to address this by moving forward legislation H.R. 2309, the Consumer Credit and Debt Protection Act, to give the Federal Trade Commission additional powers to better address consumer credit and debt issues. It was widely agreed in the hearings that the legislation that will, with the added authority H.R. 2309 would provide the FTC, it should take a broader and more effective role in consumer financial protection. With regard to the new tools, this proposal would give the FTC, the administration has addressed many of the problems that have hamstrung the Commission from taking steps to implement additional financial consumer protection, particularly with regard to the FTC rulemaking process. Magnus and Moss procedures are lengthy and cumbersome and can prevent the FTC from taking action on widespread problems in a timely and efficient manner. So I strongly support the provision in the administrative proposal that grant the Commission authority to conduct rulemaking authority under the Administrative Procedures Act. The proposal also follows 2309, granting the FTC authority to seek civil penalties for any violations of Section 5 of the FTC Act, which would provide a great deterrent to would-be actors. The portions that I propose I'm less certain about, however, would move nearly all the FTC's Consumer Protection Authority for financial practices to the newly created Consumer Financial Protection Agency. I do not disagree that additional law enforcement is a good thing for the consumers. My main concern is we're adding a new enforcement regime that is siphoning off authority from our nation's primary consumer protection agency, when that agency is more than capable of doing the job given the necessary tools and funding. Many consumer protection functions the new agency would be responsible for would be moved from other agencies and departments that do not have consumer protection as their primary function. However, this is not the case of the FTC, and I look forward to hearing from our witnesses and why the administration believes the FTC should not continue these roles. And again, Mr. Chairman, I thank you for the timeliness of the hearing. I look forward to exploring with regard to this bill and look forward to the best paths to protect consumers.
Chair, thanks, gentlemen. Mr. Pitts is recognized for 2 minutes for the purposes of opening statements.
Thank you, Mr. Chairman. Thank you for holding this important hearing on the administration's proposal to create a new agency responsible for consumer protection. I think we all agree that we need strong consumer protection measures. The recent housing and credit crisis our country has faced makes this abundantly clear. We must do this prudently, though, avoiding the mistakes of the past. It seems, however, the proposal we have before us creates yet another divided system of regulation, making rooms for gaps in oversight. We saw the effects of divided regulation at Fannie Mae and Freddie Mac, where two regulators meant less regulation, not more. The proposed new agency would also have the authority to set prices rather than allowing costs to be determined by consumers in the marketplace. Everything from ATM fees, check overdraft fees, and late payment fees for credit cards would fall under the purview of this new agency. Instead of adding layers of bureaucracy to financial regulation and intervening in the marketplace, things we've tried in the past, we should work to bring transparency and consumer choice to our markets. Consumer financial protection is a worthy goal. Unfortunately, increasing the layers of bureaucracy in the financial industry has not protected consumers in the past, and I see no reason why it will this time around. Again, we all desire effective and efficient enforcement of consumer protection laws. It is my hope that this committee moves forward in a wise and careful manner with increased transparency and consumer choice as their primary goals. I look forward to hearing from our distinguished witnesses. Thank you, and I yield back.
The chair now recognizes the gentleman from Texas, Mr. Gonzalez, for the 2 minutes for the purposes of open statement. Waive opening. The chair now recognizes the gentlelady from California, Ms. Matsui, for 2 minutes.
Thank you, Mr. Chairman, and thank you for calling today's hearing. I applaud your leadership in addressing this important issue. I'd also like to thank the witnesses for joining us today. In today's economic recession, many families in my home district of Sacramento are struggling to make ends meet. I've heard countless stories of people struggling to keep their homes, their jobs, and their way of life. California, and in particular my constituents in Sacramento, have been greatly impacted by the economic crisis. Many of my constituents were and continue to be victims of predatory home loan lending, unfair credit card practices, payday loans, and other forms of unscrupulous business practices. Just recently, the President signed into law credit card reform legislation to regulate unfair credit card practices. The ink is hardly dry, but companies are already trying to find ways to arbitrarily raise credit card interest rates and fees on consumers. Struggling homeowners are also seeking assistance to keep their homes, but continue to be tricked into contacting scam artists who just so happen to be the same crowd that initially steered homeowners into subprime loans. This is all occurring as job losses mount, foreclosures continue to rise, and Americans are increasingly turning to other forms of credit to make ends meet. It is clear that consumers are not being properly protected from unfair and deceptive financial practices. When is enough enough? The President's proposal to create a new financial consumer protection agency could be the answer the American consumers are seeking, but it must be done in a thoughtful way to ensure consumers are protected from fraudulent activity. We must make sure any new agency has real authority and just as much bite as it has bark. Consumers need to feel protected and have confidence in our financial system. Right now, it's clear they do not. I thank you, Mr. Chairman, for holding this important hearing today, and I look forward to working with you in the committee on this issue moving forward. I yield back the balance of my time.
The chair thanks the gentlelady. The chair now recognizes the gentleman from Nebraska, Mr. Terry, for 2 minutes.
Thank you, Mr. Chairman. I'll try to be quick. I think the fundamental premise of this proposed or this bill is that the FTC, the entity in charge of protecting consumers, has evidently been an abysmal failure. I don't agree with that premise. I think the issue should be how do we make sure that the FTC is properly empowered to protect consumers, and that should be what we are working for, as opposed to stripping away whatever jurisdiction they have over protecting consumers and creating some monolithic new government agency in replace of what already exists. So I'm very skeptical of this process or this bill, and I look forward to hearing from our witnesses so we can determine if FTC is capable of doing what they have been doing and whether or not this bill is even necessary. So I yield back.
The chair recognizes the gentlelady from Michigan, Ms. Sutter, for 2 minutes. Sutton.
Thank you, Chairman Rush, and thank you for holding today's very important hearing on the newly proposed Consumer Financial Protection Agency. As Elizabeth Warren aptly stated in describing the need for an agency like this, quote, "It is impossible to buy a toaster that has a 1 in 5 chance of bursting into flames and burning down your house. But it is possible to refinance an existing home with a mortgage that has the same 1 in 5 chance of putting a family out on the street. And the mortgage won't even carry a disclosure of that fact to the homeowner," end quote. Unfortunately, many people in my district who were preyed upon by so many unscrupulous companies, people know this all too well. The well-known and tragic case of one of my constituents, Addie Polk, is a shocking example of a financial product that not only caused someone to almost be homeless, but caused someone to attempt to take their own life. At the age of 86, Ms. Polk was given a new 30-year mortgage on a house she already owned, and for an amount greater than the value of her house. Let me say that again. At the age of 86, Ms. Polk was given a new 30-year mortgage on a house she already owned and for an amount greater than the value of her house. Less than 4 years later, Ms. Polk, probably of no surprise to the person who sold the mortgage to her, began to have trouble making her payments, and her house fell into foreclosure. Feeling trapped and without options, Ms. Polk shot herself rather than lose the house she lived in for 40 years. No one ever should be in Ms. Polk's position. Now is our chance, in honor of Ms. Polk and countless other Americans who have found themselves the unfortunate owners of financial products with indecipherable terms, smoke and mirror-like provisions, and gotcha fees, to truly support strong consumer protection. I look forward to hearing from the panel about how we make sure we provide the needed protection, and I yield back.
The chair thanks the gentlelady. The chair now recognizes the gentleman from Georgia, Dr. Gingrey, for 2 minutes.
Mr. Chairman, I thank you, and I thank you for calling the hearing, and welcome back John Leibowitz and Honorable Barr, the Assistant Secretary of Financial Institutions. I associate my remarks really with what the gentleman from Nebraska on our side just said, Mr. Terry. Here we are creating a whole new federal government bureaucracy when we have one already that's doing a heck of a job, as it certainly seems to me, and I think most members on this panel. So the question becomes, you know, why, to use a medical expression, throw the baby out with the bathwater? If the FTC is doing the right and proper job and the right and proper oversight, and all of a sudden we come in and spend more federal dollars, as the gentleman from Kentucky was talking about earlier, about creating a whole new federal bureaucracy. So again, I'm happy to hear from the witnesses, and maybe they can explain that. Hopefully they will explain that. But I think this is something that we need to look at very, very carefully as we just continue to create one more, or to consider creating one more government bureaucracy at a time when we're running billions of dollars of deficit year after year after year. And with that, Mr. Chairman, I'll yield back.
The chair recognizes the gentlelady from Florida, Ms. Castor, for 2 minutes.
Thank you, Chairman Rush, for calling this critically important hearing on the Obama administration's proposal for a Consumer Financial Protection Agency. Last Congress, in the wake of widespread concerns about toxic lead in paint on children's toys and other toxic consumer products, this subcommittee originated legislation to reorganize and strengthen the Consumer Product Safety Commission. And last year, as the economy plunged, there were some analogous terms being used to describe some of the mortgage and investment products. We heard about toxic assets poisoning banks' balance sheets and toxic mortgage products, leaving millions of our neighbors facing foreclosure. Predatory lenders wreaked havoc on my community, and the subsequent significant decline in property values has affected millions of folks in my home state. And unfortunately, consumers could not count on state oversight of these mortgage brokers in my home state. They just turned a blind eye, and I recommend the Miami Herald expose that documented how many convicted felons entered into the subprime mortgage loan marketing business. So this financial crisis has taught us that in order to maintain a healthy economy, effective regulation must focus on protecting consumers from abusive, deceptive, and unfair lending practices. The FTC has the enforcement authority to go after only non-depository lending institutions that deal unfairly with their borrowers, but the abuses that led to the financial crisis spread deep into the banking system. So in light of the need for more effective regulation of all lending institutions, depository and non-depository, the Obama administration has rightly proposed a reorganization. And I think all of us can agree that regulation of financial institutions must be improved to better protect consumers. However, we must be aware not only of the impact of granting authority to a new consumer financial protection agency, but also of the consequences to consumers of the changes that have been proposed to the FTC. The administration's proposal would reshape the FTC by shifting authority over consumer credit, but also by streamlining its rulemaking process and allowing it to assess civil penalties on bad actors. So I look forward to your testimony on what this new FTC might look like and how its ability to achieve its mandate of consumer protection will be affected. I yield back.
The chair now recognizes the gentleman from Louisiana, Mr. Scalise, for 2 minutes.
Thank you, Mr. Chairman. I want to thank you and the ranking member for having this hearing. The administration is proposing yet another new federal agency with vague sweeping authority. We all know there have been bad actors in our financial system that took advantage of consumers and contributed to the current economic crisis. Unfortunately, many of the problems that brought on today's financial crisis are not even being addressed in this bill. The proposed legislation does not address the real bad actors in our financial systems. Fannie Mae and Freddie Mac and other institutions that engaged in subprime lending and relaxing their standards to encourage more people to take out loans they could not afford. Those warning signs were brought before Congress for years, and yet many of the same people in this administration and in the leadership in this Congress are the same people who oppose the very reforms that would have prevented this financial crisis from happening in the first place. This proposed new agency represents yet another step in the federal government trying to run all aspects of our lives. The government is running banks and car companies with disastrous results. The so-called stimulus bill, which spends $787 billion of money we don't have, is now being recognized even by this administration as a failure that didn't create any jobs that were promised. There are even some in this administration floating the reckless idea of yet another massive spending bill since the last one didn't work. Scores of experts predict that this administration's cap-and-trade energy tax will cost us millions of jobs while increasing electricity rates on all American families. We're debating a bill that proposes a government takeover of health care, which has been tried and failed in other countries, to the point that sick people with the means in those countries come here to get their health care because government-run health care leads to rationing everywhere it's been tried. Now we have this bill to create a consumer czar. Enough is enough. Let's fix the problems that exist and make reforms to federal agencies that are causing these problems, rather than adding yet another layer of government bureaucracy that simply covers up the root causes of the problem while punishing those who played by the rules. I look forward to hearing the comments from today's panel and would like to hear how the administration's plan impacts the FTC. In his testimony, Chairman Leibowitz speaks to the successes the FTC has had in protecting consumers in financial matters, which begs the question why we need a new agency with all these sweeping new powers and spends more money that we don't have. I yield back.
The chair now recognizes the gentlelady from Colorado, Mr. Getz, for the chair. Thanks, the gentlelady. The chair recognizes the gentleman from Ohio, Mr. Space, for 2 minutes. With that, the chair thanks the gentleman. The chair recognizes now the gentleman from North Carolina, Mr. Butterfield, for 2 minutes.
Thank you, Chairman Rush, for holding this very important hearing, and I especially want to thank the witnesses for their testimony today. Mr. Chairman, I hope this hearing will provide an opportunity for the subcommittee to address some concerns that we have about the proposed agency, particularly the loss of jurisdiction on the part of the Federal Trade Commission. Now, my colleagues are right, Mr. Chairman. There are many actors to blame for the current state of our economy. Unscrupulous subprime mortgage lenders and speculators and the lack of effective oversight have all contributed to the financial meltdown. Of deep concern, and rightfully so, is the regulatory patchwork of federal agencies charged with regulating all aspects of financial institutions. For example, depository institutions such as banks and credit unions are overseen by many different agencies. Conversely, all non-depository institutions are overseen by one agency, and that is the FTC. The FTC has done a good job, and I think we can all agree on that, at regulating these players, and I am concerned that reducing FTC oversight as part of the creation of the Consumer Financial Protection Agency may do more harm than good. While I'm pleased that the administration's proposal seeks to strengthen the FTC's rulemaking and enforcement abilities in areas unrelated to financial products, I believe that it is extremely important that the FTC maintain strong non-depository institution oversight. The administration's proposed agency would seek to achieve 4 important objectives aimed at bolstering consumer confidence in financial institutions and transactions. These objectives include ensuring consumer education and understanding of these financial products, better protecting consumers from unfair and deceptive practices and discrimination, ensuring consumer financial services operate fairly, making certain that underserved communities like my district have increased access to financial services. These are excellent objectives, and I strongly support the goals of the proposed agencies, but I want to be certain that the creation of a new regulatory agency will not place undue and unnecessary strains and burdens on existing federal regulatory frameworks that may still be capable of meeting those same goals and objectives. And so, Mr. Chairman, this hearing today is vitally important. I look forward to hearing the testimony of the witnesses, and I thank you for the time.
The Chair thanks the gentleman. The Chair sees no other members who have opening statements. Now it is my pleasure to introduce panel 1 this is a 2-panel hearing, and panel 1 consists of the Honorable Michael Barr, who's the Assistant Secretary for Financial Institutions at the Department of Pleasure. We want to welcome Mr. Barr back to this committee once again. And also joining him at the witness table is someone who is very familiar to this subcommittee, the Honorable John Libowitz, who is the Chairman of the Federal Trade Commission. And Chairman Libowitz, we certainly welcome you back again to this subcommittee. It is the practice of this subcommittee now to swear in the witnesses, so I would like for you, each of you, to stand and raise your right hand. Yeah. Do you solemnly swear to tell the truth, the whole truth, and nothing but the truth? Let the record reflect that the witnesses have answered in the affirmative. Now, we want to recognize, beginning with Mr. Barr, the witnesses for an opening statement. You have 5 minutes or thereabouts for your opening statement. Thank you. All right. Mr. Barr, you're recognized for 5 minutes or thereabouts.
Thank you, Mr. Chairman, and thank you, Ranking Member Radonovich, for providing me with this opportunity to testify about President Obama's proposal to establish a new, strong financial regulatory agency charged with just one job, looking out for consumers across the financial services landscape. As Secretary Geithner has said, protecting consumers is important in its own right and also central to safeguarding our financial system as a whole. We must restore honesty and integrity to our financial system. That is why President Obama personally feels so strongly about creating this new Consumer Financial Protection Agency. I understand the committee's concerns that have been expressed today with respect to boundary issues, jurisdictional issues, and the role of the FTC. I think as we work together on those issues, it's important to keep in mind the central goal we all share, having one agency for one marketplace with one mission, protecting consumers. The new agency will have the authority and the resources it needs to set consistently high standards for banks and non-bank financial providers alike, to put an end to regulatory arbitrage, to put an end to unregulated corners of our financial system that inevitably weaken standards across the board. This agency will be accountable for its mission, yet independent. It will have a wide range of tools to promote transparency, simplicity, and fairness. It will act in a balanced manner, considering costs as well as benefits, in a way that protects consumers from abuse while ensuring their access to innovative, responsible financial services. It will be able to reduce regulatory burden while helping consumers. For example, by creating one simple mortgage disclosure form for all consumers to use. It will not set prices for any service. The federal government has failed to date in its most basic regulatory responsibility, utterly failed to protect consumers. The deep financial crisis that we are still in, let me emphasize that we are still in today, revealed the alarming failure of our existing regime to protect responsible consumers and to keep the playing field level for responsible providers. Instead of leadership and accountability, we have had a fragmented system of regulation designed for failure. Bank and non-bank financial service providers compete vigorously in the same consumer markets, but are subject to two different and uncoordinated federal regimes, one based on examination and supervision, the other on after-the-fact investigation and enforcement. Less responsible actors are willing to gamble that the FTC and the states lack the resources to detect and investigate them. This puts enormous pressure, too, on banks, thrifts, and credit unions to lower their standards to compete and on their regulators to let them. And no financial provider should be forced to choose between keeping market share and treating consumers fairly. This is precisely what happened in the mortgage market. Independent mortgage companies peddled risky mortgages in misleading ways to borrowers who could not handle them. To compete, banks and thrifts and their affiliates relaxed their standards on underwriting and sales, and their regulators were slow to act. The consequences for homeowners were devastating, and our economy is still paying the price. Fragmented regulation facilitated abusive credit cards. Tricks and traps enabled banks to advertise selectively low annual percentage rates to grab market share and boost income. Other banks could not compete if they offered fair credit cards with transparent pricing, and consumers ended up with retroactive rate hikes and unfair terms. The list goes on and on. Credit unions and community banks with straightforward credit products struggled to compete with less scrupulous providers who appeared to offer a good deal and then pulled a switch on the consumer. Our federal agencies do not currently have the mission, structures, and authorities suited to effective consumer protection in consumer financial markets. The FTC has no jurisdiction over banks, and it does not have the supervisory and examination authority to detect and prevent problems before they spread throughout the market. Mr. Chairman, I see that I will be significantly over my time. Could I take several additional minutes?
Yes, you so approved.
Thank you.
You're on your thereabouts part of your testimony.
Thank you. Bank regulators have supervisory powers over banks, but their primary mission is to ensure that banks are safe and sound and not to protect consumers. Consumer protection supervision is never going to share the front seat with safety and soundness. Tinkering with the consumer protection mandates or authorities of our existing agencies cannot solve these structural problems. We need a structural solution. We need one agency for one marketplace with one mission to protect consumers of financial products and services and the authority to achieve that mission. That's the agency we are proposing to create. The CFPA will have the sole mission of protecting consumers. It will write rules, supervise institutions, examine them, and lead enforcement efforts for the whole marketplace. The implications for our proposal for consumer protection and competition are enormous. The proposal will bring higher and more consistent standards, stronger, faster responses to problems, the end of regulatory arbitrage, a level playing field for all providers, and more efficient regulation. Our proposal gives the agency the power to strengthen mortgage regulation across all lenders and brokers. It can strengthen disclosure, make it easier for consumers to choose simple products, prevent lenders from paying yield spread premiums that pay brokers more if they deliver loans with higher rates than consumers qualify for. The agency would implement credit card protections and update these protections as markets change. And it would set high national standards for licensing, bonding, monitoring of all non-bank financial services providers. Let me say, the FTC is a good agency. The chairman and I are good friends. Our legislation does not affect the jurisdiction of the FTC over the vast array of non-financial markets and actually strengthens its ability to police those markets. To increase the FTC's ability to protect consumers, we propose that the FTC be able to adopt rules to prohibit unfair or deceptive acts or practices with standard notice and comment rulemaking, to obtain civil penalties when companies act in an unfair or deceptive way, and to pursue those who substantially aid and abet providers that commit unfair or deceptive practices. The administration also supports increased resources for the FTC so that consumers can be better protected across all markets. As for financial markets, the FTC would continue to have authority under the FTC Act to pursue financial fraud without delay, including on foreclosure rescue and loan modification scams. The FTC will retain authority for writing rules under the Telemarketing Sales Act and concurrent responsibility for enforcing them over financial products and services. And the FTC would retain primary authority in the area of data security for non-bank entities. In addition, the FTC would have backstop authority to enforce the same consumer credit statutes that it can enforce today. Under that authority, the FTC, or frankly a bank regulator, could, if it becomes aware of a possible law violation, refer it to the new agency, and if the new agency doesn't act, take action itself. That same referral requirement will apply to the bank regulators, and it is designed to ensure a consistent federal approach to interpreting and enforcing our consumer protection statutes. Finally, let me just say this. It is time to put consumer protection responsibility in an agency with a focused mission and comprehensive jurisdiction over all financial services providers, banks and non-banks alike. It is time for a level playing field for all financial services providers. It is a time for an agency that consumers and their elected representatives can hold fully accountable and responsible for consumer protection in all financial sectors. And it is also long past time for a stronger FTC. The President's legislation fulfills these needs. Thank you for this opportunity to discuss the proposal, the additional time you have graciously given me, and I will be happy to answer any questions at the conclusion of our opening statements.
Mr. Chairman, I would like to make a unanimous consent that the gentleman from the FTC have 9 minutes.
I believe I'll be giving back at
The chairman of the FTC would take whatever time he may consume.
We've been having a little problem with the microphone. Chairman Rush, Ranking Member Radonovich, Vice Chair Schakowsky, members of the subcommittee, I appreciate the opportunity to be here to discuss consumer protection regulatory reform, including President Obama's far-reaching proposal to enhance consumer protection through the creation of a new Consumer Financial Protection Agency, the CFPA. As all of us in this room know, and as many of you on the panel articulated, and as Mr. Barr also effectively articulated, the need for reform has become as painfully clear as the distress that consumers are now experiencing in these difficult economic times from the failure of regulation. All of us on the Commission support the President's goal of elevating consumer protection, although some of us have different views as to the best means to that. Thank you so much. You see, we are good friends. Although some of us have different views as to the best means to that end. For my part, this initiative, which enhances resources and authority for the FTC and which creates the CFPA, is clearly preferable to the status quo. In any case, the Commission will continue to vigorously protect consumers of financial services while this proposal is under discussion. CFPA, if it's enacted, is ramping up. Beyond that, we look forward to working collaboratively with the new agency. Thank you so much. Now I feel like I'm at a press conference. In the last 5 years, we've brought more than 100 financial consumer protection cases and have recovered nearly $500 million in the last decade for consumers. Since I last testified before the subcommittee in late March, we've continued aggressively pursuing financial predators, bringing 14 new cases in this area. In fact, today we're announcing distribution of an additional $8 million in consumer redress checks to Americans who were deceived by deceptive mortgage origination fees. And on June 1st, using the new APA rulemaking authority that you gave us in the Omnibus Appropriations Bill, we began a rulemaking addressing mortgage modification and foreclosure rescue scams, which have become, as all of you know, all too common recently, and also addressing the entire mortgage life cycle, advertising, origination, appraisals, and servicing. Simply put, This work will help ensure that consumers aren't ripped off by bogus mortgages or false advertising. Mr. Chairman, President Obama emphasized the importance of giving the FTC tools and increased resources, the ones that we need to stop practices that harm consumers and violate the law. First, the proposal grows our agency, giving us the staff that we need to do the job that you all want us to do. Currently, we have just over 1,100 FTEs. That's down from about the 1,800 FTEs we had in the late 1970s and early 1980s, despite a considerable growth in the U.S. population and in our own responsibilities, including enforcing canned spam, do not call, COPPA, the Children's Online Privacy Protection Act, Gramm-Leach-Bliley, FACTA, and other statutes. Second, the proposal provides the FTC with APA notice and comment rulemaking, which is used by virtually every other agency in the federal government. It would strengthen the Commission's ability to address widespread problems more quickly. Third, the proposal authorizes the FTC to obtain civil penalties for violations of Section 5 of the FTC Act. This new power, we believe, would help deter would-be violators and help consumers help protect consumers more effectively. I think something like 47 state attorneys general have fining authority. And by the way, fining authority was originally proposed by Caspar Weinberger when he was chairman of the Federal Trade Commission under President Nixon in the early 1970s. Finally, the proposal authorizes the FTC to go after those who aid and abet others who violate the law. We'd also urge Congress, as you consider this legislation, to give both the FTC and the CFPA the ability to bring civil penalty actions on our own, which would put both of us on equal footing with other consumer protection agencies like the SEC and the CFTC, and not make us, as we do, currently have to wait for the Justice Department to clear our going forward. Now, we expect that, as with any bold and complex new initiative, clarifications will be worked out as the legislative process moves forward. But from my perspective, the President's goal of streamlining the overall system for protecting consumers from financial abuse is more than commendable, and eliminating the balkanization of consumer protection oversight over non-banks and banks, as Mr. Barr has alluded to, is laudable and very, very critical. We do have some concerns, however, about the draft legislation, or the legislation in its, as it was initially drafted, although I'm optimistic that we can work these out as the legislative process moves forward. So, for example, the proposal states that the FTC would have backstop authority, but the draft legislation imposes a review period that could require us to wait 120 days before filing certain cases. We also believe it would be helpful to make definitions of the proposal's terms, such as credit and financial activity, clearer. And let me tell you why with an example. So suppose the FTC finds a telemarketer making illegal robocalls to millions of consumers on the Do Not Call registry, urging them to purchase something like advance fee credit cards, which are, I wouldn't say per se illegal, but almost always, but let's say often illegal. And suppose that a payment processor participated in the fraud. It is critical that we be able to bring an action against all of the malefactors expeditiously. But it's unclear under this draft whether we'd have the jurisdiction over the telemarketer offering the financial products or the payment processor, and if so, whether the 120-day waiting period would come into play. Now, we've made much progress with Treasury on several of these boundary issues, and we're continuing to make progress. But getting this right and allowing us to put an immediate halt to harmful practices is crucially important. Having said that, with this committee involved in writing any legislation, I am confident that this very, very important initiative will be considered, discussed, clarified, and refined, with all open issues resolved in favor of American consumers. We understand, of course, that under this proposal, rulemaking authority and primary enforcement responsibility for financial products and services would go to the new agency, but we will continue to aggressively enforce these laws as a cop on the beat where necessary, as well as each and every other consumer protection law within our jurisdiction. We look forward to working with the administration and Congress to reach a plan that best protects American consumers, and I thank you for your time.
The Chair,
happy to answer questions.
Yes. The Chair thanks the gentleman, the Chairman of the FTC, and the Chair now recognizes himself for 5 minutes for the purposes of questioning the witnesses. with the continuation of the financial crisis, we see more and more scam artists preying on desperate consumers seeking to reduce their debts and to keep their homes out of foreclosure or from selling their homes at a loss. And I'm concerned about this proposal in that this new agency will not do enough in the short term because we all know that it takes some time for a new agency to rev up and to get going and to get running. Another option that the administration might have considered is proposing that the FTC take on this essential role and by increasing its staff and authority, it's conceivable that FTC could be taking on these issues within weeks or months rather than years. Mr. Barr, did the administration consider other options other than creating a new agency?
Yes, Mr. Rush. Let me just say, Mr. Chairman, that with respect to the transition issues, our view is that the FTC should act aggressively, as it is doing now under the Chairman's leadership, to continue to enforce the law, be a cop on the beat, be quite aggressive in this area. And we are, at the same time that we are pushing to create the new agency, pushing on all the existing agencies, working closely with them to do everything we can under existing authority. So I don't think there's any sense that anybody thinks we should slow down, rather quite the opposite. With respect to other options, the administration considered a wide range of options with respect to consumer protection. And our basic view was that the existing system was fundamentally broken, and we needed a quite large, significant change to create one agency whose sole job was protecting consumers across the financial services marketplace. I think that the Chairman is deeply aware of the ways in which consumers have been abused and neglected for quite a long time, and the existing structure is just inadequate to meet the need. So our strong view, the President's personally strong view, was that we needed a new financial agency with that core mission that was strong and could achieve the goals that I think that the Chairman articulated so eloquently in the opening remarks.
Chairman Leibowitz, during this interregnum between this bill becoming law and implemented and this new creation actually taking place, that's going to put a lot of more pressure on the FTC. Do you have the requisite resources and personnel? How will the FTC function during this interregnum?
Well, I would say that during the sort of interregnum period, if the legislation is enacted, we're going to work very closely with the new agency. I think the period for transfer is somewhere between 6 and 24 months, depending on how quickly they're ready to ramp up. We're going to continue to bring cases. I do think it's, and I think that was always the notion. I do think that going forward, we could use more resources, and we've talked about this before in hearings. And I do think that even after the agency is created, assuming it is, that it would be useful for us to have concurrent enforcement authority, so that if we're going after, the bad guys don't always act in silos, as Mr. Barr knows, and as all of you know. Sometimes they're violating the do not call rule, and they're violating Reg Z or Reg E, which would go over to the new agency. And so I think it's important going forward that when there's ongoing consumer harm, that we're able to sort of jump over the kind of legislative, the new legislative fence to help consumers and not have to wait potentially 120 days. I think we're working through a lot of these issues and making a lot of progress between our staffs and ourselves.
The chair sees that his time is up. The chair now recognizes the ranking member for 5 minutes.
Thanks, Mr. Chairman, and welcome, gentlemen, to the panel. I'm pleased to see you here today. Mr. Leibowitz, and welcome back to the committee. I know you've been here a number of times already and probably will be more in the future. I got to think you're doing a bit of a dance because you stand to lose some jurisdiction in the FTC. And it seems to me that you're getting, or at least under the proposal, getting more money and authority to do less. And I want to know what your reaction to that statement is, given the fact that the FTC has dual jurisdiction, and that is two missions, to ensure competition, but also consumer protection.
Well, Mr. Radonovich, let me just start by saying I hope that familiarity is not breeding contempt here.
Not at all.
And,
not at all.
Look, you know, if you read through our written testimony, you can sort of see it's a complex matrix within the Commission about what we support and what we don't. I do think from our perspective, if you create this, from my perspective, if you create this new agency and you also give us more resources and authority, from the perspective of consumers, they will be getting a better deal because we'll continue to have a backstop authority with respect to financial matters. And we're going to be able to concentrate and just do more for consumers. As you know, and because we've talked about this, we spend a lot of time leveraging
if I may, but
resources.
you are losing jurisdiction.
Well, we would be losing jurisdiction, and we'd be losing
then how does that loss of jurisdiction deal with your two missions of ensuring competition and providing consumer protection?
Well, I would say on the competition side, we wouldn't be losing jurisdiction. We'd still retain that jurisdiction. On the consumer protection side, we would be losing jurisdiction to this new agency, but this new agency would be another cop on the beat protecting consumers, and we'd also be losing personnel. We have and we have already lost a few personnel, I would say, to the new agency.
It does seem to me like you're getting more money and authority to do less.
Well, we'll do more. I mean, we really will. It's not a question from our perspective of moving to a government sinecure. I mean, our guys work extremely hard. They've been commended by OPM for always scoring high on sort of effectiveness and quality of work. And we'll just do more in the areas where we have, while retaining backup authority, if the proposal goes through, we'll do more in the other areas of consumer protection, and there's plenty to do.
Mm-hmm. Thank you. Thank you. Mr. Barr, welcome to the subcommittee. You know, in Russia, during the height of communism, it was often talked about the fact that there was not a lot of food on the shelves. And when you'd go into stores, you might be able to get a loaf of bread, but if you wanted sourdough, you probably had to have the standard loaf. If you wanted rolls, you got a loaf of bread. If you wanted something else, you got a loaf of bread. Explain to me how you're not doing the same thing in the credit markets in the name of consumer protection.
Thank you very much for that terrific question. I was smiling because as you were describing the example, I spent some time in Poland and had the same experience where you go to the store and there's nothing there and you can actually literally go hungry. This agency has nothing to do with that. Literally nothing to do with that.
Tell me how you're not doing that, though, in the credit markets. Then that would be the question I'd like answered.
The new agency is in no way pursuing that kind of command and control model. It's in no way pursuing price setting. It's in no way saying you can't offer certain kinds of products. The new agency under the legislation.
And I understand the reason for looking at this because we've all, experiencing this financial crisis. But doesn't this end up providing consumers with less choice and driving up the cost of credit for consumers?
With respect, sir, our strong view is that it does not. It continues to provide for financial innovation. Consumers can get access to whatever products and services providers want to offer. Our basic approach is to improve disclosure, reduce regulatory burden, for example, by merging TILA and RESPA authorities. You can have one simple mortgage form at the time of disclosure.
But weren't there existing authorities that have and could and should deal with the current crisis that we're in, doesn't the added restrictions and regulations that you're going to be putting on the credit industry will drive up the cost of credit to consumers?
I think that the better judgment, sir, again with respect, is that the current system we've had, the status quo on consumer protection, was a dismal failure. And I think we have evidence all around us of that. And our view was, both for banks and for non-banks, for consumers and for households, the system failed. If you talk to, I'm sure you do, the community bankers in your community who had to compete against unregulated providers who were sucked into
Actually,
offering
they're
products
competing against
they don't
large
want.
banks for TARP money, but thank you very much, Mr. Chairman. I yield back.
The chair now recognizes the gentlelady from Illinois, the vice chair, Ms. Schakowsky.
Thank you. Mr. Barr, could you describe how we potentially would have been in a different situation today had this agency been in existence as the current problem started to unroll?
Yes, I think we would have been could have been in a fundamentally different situation if we had an agency that could set the rules of the road for everybody to follow. If we had an agency that could say to mortgage brokers, you can't get paid more for offering riskier, higher priced, more confusing products than a basic product. If we had a rule that said, mortgage brokers, you have a duty of care, you have to do best execution for a mortgage, so you can't offer the mortgage that's the best deal for the broker, you're supposed to offer a mortgage that's the best deal for the consumer. If we had a duty that said, mortgage brokers have to have some skin in the game, they need to be paid over time, securitization trusts have to have skin in the game so that you don't have a system where all the bad mortgages are made up front and eventually sold to the investor at the other end with nobody in the chain having responsibility, nobody having any of their own capital at risk. So we could have had fundamental change. We could have had a fundamentally different situation in which consumers were protected at the front end and the financial system was protected all the way through.
And you're saying without any change in legislation beyond the creation of this agency, that you would have the authorities then under the bill, which I haven't read thoroughly yet, you would be able to have done all those things?
Yes. This agency would be granted the authority to do all the things that I just described.
Did you want to comment on that, Mr.?
Well, I just say that sort of one of the things that's critical here is APA rulemaking authority, and of course under the new proposal, they'll be able to do it for non-bank as well as bank-related financial instruments and mortgages. And so in the omnibus, you gave us, and for which we are very grateful, APA rulemaking for non-bank mortgages. And we're going to look at that, and we're going to do, I think, a very, very good rule. And Mr. Rush, you have legislation that would expand our jurisdiction a little bit more, but it only goes, but it's only within the context of non-bank issued financial instruments. So 20 years ago, we did a lot of matters relating to credit cards, and all the credit cards are now, virtually every credit card is now issued by a bank. We have no jurisdiction there. So I think that's a critical advantage from the consumer's perspective of what this new agency might do.
Let me just say that while I absolutely, in theory, think pulling it all together in one place is a good idea, but, you know, we've seen in the startup of the Department of Homeland Security lots of difficulties in pulling it all together and making it all happen. The creation of a Director of National Intelligence. Certainly in that case, many of us on the Intelligence Committee see a large bureaucracy itself developing and, you know, have some problems with the coordination that was actually supposed to happen. How can we be assured that this will achieve its goals, achieve it in a timely way, and not just be another bureaucracy?
Thank you very much. Again, I think that our view is the agencies that have the authority now should aggressively use those authorities. Those authorities are inadequate to the task. The basic structure of the system was a dismal failure. We need to do this. We need to take this action. The legislation has tight timelines for transition. Treasury has responsibility to make sure that transition happens effectively. You can come see me. You can come see Secretary Geithner. We're responsible for making sure you can hold us accountable.
The chair recognizes Mr. Stearns from Florida.
Thank you, Mr. Chairman. Mr. Chairman, we've had a lot of hearings on privacies here on this committee, and when I was chairman of the committee, we had many hearings on privacy, and I think my concern is that if we transfer some of the Federal Trade Commission's privacy work to this new CFPA, particularly in light of all the expertise that you have, and you've been the leading federal agency in the area of consumer privacy for all these years, and including financial privacy, as well as identity theft, information security. So with that in mind, what do you feel about this transfer?
Well, I guess I'd make a couple points. And this committee and you have been leaders on privacy-related issues. You know, we'll be transferring over a lot of laws. We hope to keep sort of a backstop authority that is concurrent. And of course, this is the beginning of the legislative process. It's not the end. And you know, I see a lot of agreement on many things within this committee on ways to go forward. I think the way we read the legislation, it was unclear whether issues like data security, privacy would stay with us. I think Mr. Barr is represented today. The better reading of the proposed statute, or the reading of the way the proposed statute will move forward, is that we'll keep issues like that, and I think that's very, very important.
So identity theft, you'd still keep?
I think we would keep identity theft.
And
yes.
Financial privacy?
Financial privacy, I think, mostly moves over to the new agency. I mean, again, I think that's to some extent up to you. I think we would keep the safeguards rule under Graham-Leach-Bliley, but a lot of this has to be worked through. Of course, during the transition period, we'll keep on doing this, and again, we'll have backstop authority. We won't be doing the, and I should probably turn this over to Mr. Barr, who's one of the true architects of the plan.
But so what you're saying today is that some of this is still up for negotiation.
Yeah, these boundary issues that you've raised, the same concerns that we saw when we got the legislation at the end of last week. But it seems that it's being resolved on many of these boundary issues in favor of retaining jurisdiction by the existing commission. And I assume that's what, you know, if this legislation moves forward, that's what this committee would be most interested in. But let me turn it over to Mr. Barr.
Yeah. Just to add to that, the chairman is correct with respect to data security issues, identity theft issues, safeguard, red flags. All that would stay at the FTC, and the parallel authority for that at the bank agencies. But the front-end privacy notices that have to do with disclosure would fit in the new disclosure regime of the new Consumer Financial Protection Agency.
So let's say internet privacy, consumer privacy, would that be part of, would that remain with Federal Trade Commission?
Again, with respect to the disclosure aspect on the financial side, the disclosure would be unified with the disclosure regime at the new financial agency. All the data security, identity theft, and related issues would remain at the FTC, and the parallel authorities with respect to banks.
But if you're thinking about core issues like spam, spyware, behavioral marketing, we keep all of those. You know, there might be some issues about whether we're going after a malefactor or a group of malefactors, and one of them is on the other side of the core new agency's fence. You know, right now there's a 120-day waiting period, which we are a little concerned about from the perspective of consumers. But going back to your original point, sort of a variety of issues, including sort of the core privacy issues we do, we'll be keeping and retaining jurisdiction.
Well, I think, Mr. Barr, what you should realize with all that expertise in the Federal Trade Commission, we're starting a new federal agency here. You know, I would think that, as many have pointed out on this side, we're worried about a new federal agency, particularly when you have an agency that already has the expertise. I think the bill says that the cost of this new development of this new agency is such sums as are necessary. Is there any more definitized information you can give on what the cost would be for this new federal agency?
I don't at this time have an overall cost estimate for the agency or size estimate for the agency. It's something we're working on. We'll work with the appropriate committees on and with OMB and CBO on. We anticipate that the agency will be pulling in staff and resources from the existing agencies and additionally having new resources required. I'd be happy to continue to work with you on that question.
Can you talk about the resources the agencies will need besides, I mean, have you identified any of the resources?
We have begun the process of identifying the number of individuals and the other resources the agency would need, but we are not at a place now where I could give you even a reasonable estimate of that. What additional measures beyond the transfer authorities would be required. It is something we are working quite hard on.
I'll just close. Mr. Chairman, you might think as a subcommittee chair, since a lot of the expertise for this is already in the Federal Trade Commission, and this is a new agency, you might, and particularly your jurisdiction here, I think we've got to move carefully, as Mr. Dinkle pointed out, of developing a brand new agency. They don't know how much they're going to spend. They don't know what resources they're going to need. And also, they're going to be taking on expertise for areas they know nothing about that the Federal Trade Commission has years on. So I just wonder, as you as a chairman, you might want to be very careful and cautious about endorsing this new agency without you know, some more hearings on it and try to get more of the stakeholders here, perhaps more than we have on the witness list here, to try and get into the discussion here. So I thank you, Mr. Chairman.
The chair, thanks to the gentleman. The chair observes that there's a vote going on the floor. There are 3 votes. It is the desire of the chairman that we should delay the committee hearing for until after the votes are concluded, and then return. I'm not sure what the witnesses, what their time commitments are, but it would be very important that you return. I would say within 15 minutes after the last vote, then the subcommittee will reconvene. So the subcommittee, is that all right with the?
Yes, Mr. Chairman.
Right.
Also with Consumers